If you own silver, you have only weeks left to prepare for what's next. Not months, not eventually. Weeks. The window that opens before every major financial shift has already begun closing, and most business owners won't realize it until it's too late. Right now, while you're watching this, something is happening in the physical metal markets that hasn't happened since 2008. Premiums are expanding, inventory is thinning, delivery times are stretching, but the price, still quiet. That contradiction is not random, it's a signal. The same signal that appeared before every currency crisis in modern history. And if you don't understand what it means, the next few weeks will decide whether you're positioned or exposed. Welcome to Currency Forensics. This is where we examine what the financial system doesn't want examined, and where serious business minds come to prepare, not to panic. Now, a simple request, the kind you'd make to someone with decades of experience who values straight talk. If this analysis matters to you, if you understand that preparation separates the protected from the exposed, take 3 seconds and subscribe. Not for entertainment, but because strategic intelligence has value. And before we continue, tell us in the comments, where in the world are you watching this from? Because currency instability doesn't respect borders, and neither does our community. Now, let's begin the forensic examination. There's a pattern in history that repeats itself, and right now that pattern is forming again. When currencies weaken, when debt becomes too heavy, when governments print more money than the system can absorb, something shifts, and silver, quiet, overlooked silver, suddenly becomes important. Not because it is magical, but because it is real. A business owner in Germany learned this lesson in 1923, when his paper savings became worthless overnight. But the small amount of silver he kept fed his family for months. Another entrepreneur in Argentina watched it happen in 2001, when banks froze accounts, when ATMs stopped working, when paper promises meant nothing. The ones who survived were the ones who prepared before the crisis became obvious. Today, the same pressure points are building. The global debt, the amount governments and corporations owe, has reached levels never seen before in human history. Countries are spending more than they earn and covering the difference by printing money. And when money is printed, it loses value. Not immediately, not dramatically, but steadily. Groceries cost more, rent increases, insurance premiums climb, and slowly the average person realizes their savings are buying less. This is not theory. This is happening now. But most people do not see it as a crisis. They see it as normal. They adjust, they complain, but they do not prepare. And that is the mistake. Because when the system is under stress, it does not send an invitation. It does not announce the crisis date on a calendar. Instead, it sends signals. Signals that most people ignore until it is too late. Right now, in the silver market, those signals are appearing. Dealers are reporting something unusual. The price of silver, the number people see on financial websites, has stayed relatively calm. But the premium, the extra cost dealers charge above that price, has been climbing. When a dealer's premium rises while the official price stays flat, it means something. It means demand is increasing, but supply is getting tight. It means people who understand these cycles are quietly positioning themselves. And it means the gap between what the market says and what reality shows is widening. This gap has appeared before. In 2008, just before the financial crisis, silver premiums began expanding weeks before the mainstream panic started. In 2020, when COVID lockdowns began, premiums exploded overnight, and physical silver became nearly impossible to find. Those who waited for the headlines paid double, triple, or could not buy at all. Those who acted on the signals secured their position early. The difference between these two groups was not luck, it was timing. And timing comes from understanding what to watch. Another signal is appearing in delivery times. Normally, when someone orders physical silver, it ships within days. But recently, fulfillment times have been stretching. 1 week becomes 2 weeks. 2 weeks becomes 4. This does not happen when supply is abundant. This happens when demand is quietly overwhelming the system. And then there are the inventory levels. Major dealers, the ones who supply silver to the public, are reporting lower stock levels than usual. Some products show out of stock more frequently. Some weights and sizes are simply unavailable. Again, this is not random. This is pressure building beneath a surface that still looks calm. Most business owners, most investors, most people planning their financial future are not paying attention to these details. They are watching the price. Because the price has not exploded yet, they assume there is no urgency. But price is only part of the story. Access is the other part. And access is already tightening. The business owner who waits for the price to spike before acting will find that the real problem is not price. It is availability. Because when a crisis becomes obvious to everyone, everyone moves at once. And the system, The dealers, the mints, the supply chain cannot handle everyone moving at once. This is not speculation. This is documented reality from every previous cycle. So the question is not whether this pattern will repeat. History has already answered that question. The question is, will someone be positioned before the window closes, or will they be caught unprepared when it does? Because the window is not open forever. It is open now, for a limited time, while most people are distracted, while the mainstream media is quiet, while the crowd is not paying attention. But that silence is ending. The signals are getting louder, and the business owners who understand what these signals mean are moving now, not with panic, but with precision. Because preparation is not about fear. Preparation is about structure, and structure is built before the storm arrives. There was a businessman in Cyprus, 2013, who thought he had done everything right. He had savings, he had investments, he even owned some gold. But when the banks froze, when the government took a percentage of every account to pay national debts, he realized something critical. He had assets, but he did not have a system. And when the crisis hit, assets without a system became a trap instead of protection. This is the mistake most silver owners are making right now. They buy the metal, they feel prepared, and then they stop building. They assume the silver will do the work for them. It will not. Silver is not a magic solution. It is one tool in a larger framework. And without that framework, even the right tools fail. So what is the framework? What separates someone who survives financial turbulence from someone who gets crushed by it? The answer is not complicated, but most people ignore it because it is not exciting. It is called the 4-pillar system. 4 pillars that hold up financial resilience no matter what happens in the economy. Pillar 1, cash buffer. Not investments, not stocks, not crypto. Actual liquid cash that can be accessed immediately. Most business owners treat cash like it is worthless. They say, cash loses value to inflation. Why would I hold it? And they are partially right. Cash does lose purchasing power over time, but cash has one ability that nothing else has. It buys time. When an emergency happens, when an opportunity appears, when something breaks, the person with cash has options. The person without cash has to sell something, usually at the worst possible moment. This is how wealth gets destroyed, not by market crashes, but by forced selling during crashes. So the first pillar is simple. Keep enough cash to cover essential expenses for 3 to 6 months. Not hidden under a mattress, but accessible within 24 hours if needed. This is oxygen. Without oxygen, nothing else matters. Pillar 2, debt control. Debt is not just a number on a balance sheet. Debt is a claim on future income. And when the economy gets stressed, when income becomes uncertain, debt becomes a weight that pulls people under. High interest debt is especially dangerous. Credit cards, personal loans. Any debt charging more than 10% per year is actively working against financial resilience. Every dollar paid in interest is a dollar that cannot be used for protection, for opportunity, for survival. So the second pillar is debt reduction. Not because debt is evil, but because debt creates vulnerability. The business owner with low debt can survive a revenue drop. The business owner with high debt cannot. It is that simple. And here's the truth most people do not want to hear. If someone owns silver, but their debt payments are crushing them every month, they have not prepared. They have just shifted their vulnerability. Because when pressure comes, they will be forced to sell that silver to cover debt. And forced sellers always lose. So debt must be addressed before metals or alongside metals, but never ignored. Pillar 3, skill leverage. This is the pillar most people completely miss. They focus on assets, on investments, on what they own. But they forget the most valuable asset of all, their ability to earn. Skills are income insurance. When the economy shifts, when industries collapse, when companies lay off workers, the people who have multiple skills adapt. The people with one skill, one income source, one way to earn, panic. A business owner who only knows one industry is fragile. A business owner who can consult, who can teach, who can solve problems in multiple areas is anti-fragile. So the third pillar is skill development. Not someday, not when there is time, now. Because skills take time to build, and time is the one thing a crisis does not give. The entrepreneur who learns marketing, finance, sales, negotiation, writing, has options. The entrepreneur who does not has hope, and hope is not a strategy. Pillar 4, asset allocation. This is where silver finally enters the picture. But notice, it is the fourth pillar, not the first, because silver only works when the other 3 pillars are already in place. Asset allocation means spreading resources across different types of assets, so that no single surprise can destroy everything. Some cash for liquidity, some productive assets for growth, some protection assets for insurance. Silver fits into the protection category. It does not generate income. It does not grow a business, but it holds value when paper currency fails. It is outside the banking system. It does not require permission to own. It does not depend on a government promise. And in a world where governments are printing money faster than ever before, that independence has value. But here's the critical part. Position sizing. Most people get this wrong. They either buy too little, so it does not matter if silver goes up, or they buy too much, so they cannot sleep when silver goes down. The correct position is simple. Buy what can be held through volatility without panic. If a 30% drop in silver would force someone to sell, they bought too much. If they can watch a 30% drop and hold calmly, they sized correctly. Because silver will be volatile. It always is. And volatility is how the market removes weak hands. So the four pillars work together. Cash gives flexibility. Debt control gives freedom. Skills give income security. And allocation gives protection. Without all four, the structure is weak. With all four, the structure can absorb shocks that would break most people. This is not theory. This is how financial resilience actually works. And the business owners who build this system now, while there is still time, will not panic when the pressure arrives. They will be ready. In 2007, a small group of investors noticed something strange. Housing prices were still climbing. The stock market was still celebrating. The media was still declaring everything fine. But in the credit markets, in the bonds that nobody talks about, something was breaking. The signals were there, clear as day, for anyone who knew where to look. Most people did not look. They trusted the headlines. They trusted the experts. They trusted the surface. And when the collapse came in 2008, those people lost everything. But the ones who read the signals, the ones who paid attention to what was actually happening beneath the noise, they not only survived, they positioned themselves to profit. The difference between these two groups was not intelligence. It was awareness. They knew what to watch. And more importantly, they knew what those signals meant. Right now, in the silver market, those same types of signals are appearing again. And most people are missing them because they are looking at the wrong thing. They are staring at the price chart, watching the number go up and down, checking it every day like it is a heartbeat monitor. But price is the last thing that moves. Price is what everyone sees when the shift is already complete. The real signals, the ones that matter, appear in the friction. Friction is where truth lives. Let me explain. When someone goes to buy physical silver online, they see a price. That price looks official, looks clean, looks like reality. But then they notice something else. The dealer premium, the amount added on top of that official price, is higher than it used to be. Not by a little, by a lot. A few months ago, premiums might have been $2 per ounce above the spot price. Now, they are $5, $6, sometimes more. Why? Because demand is overwhelming supply. But the official price, the one everyone watches, does not reflect this yet. This gap between the paper price and the real cost is friction. And friction is a signal. It is the market whispering. Something is wrong. Another signal. Delivery times. A customer orders silver, expecting it to ship in 3 to 5 business days. Instead, they receive an email. Due to high demand, your order will ship in 2 to 3 weeks. 2 weeks becomes 4 weeks. 4 weeks becomes 6 weeks. This is not normal. This is what happens when the system is stretched thin. When mints cannot produce fast enough, when dealers cannot restock fast enough, when the physical metal is moving faster than it can be replaced. And yet, the price chart still looks calm. This is the second signal. Then there is inventory. A person visits a dealer website looking for a specific product. 1 ounce rounds, 10 ounce bars, whatever they prefer. And they see the words, out of stock. They try another dealer. Same message. They try a third, limited availability. This does not happen when supply is abundant. This happens when the physical market is tightening, even while the paper market pretends everything is fine. This is the third signal. Now, here is what most people do when they see these signals. They ignore them. They think, maybe it is just temporary. They think, if it was serious, the price would be exploding. They think, I will wait and see what happens. And this is exactly how people get caught unprepared. Because the window does not stay open, it closes gradually, then suddenly. First, the easy products disappear, the popular sizes, the common weights, gone. Then the less common products disappear, then everything that is left costs more. And by the time the price explodes, by the time the mainstream media starts talking about it, availability is the real problem, not price, availability. This exact pattern happened in March 2020. Silver prices actually dropped for a few days, and people thought it was a buying opportunity. But when they tried to buy, they could not. Dealers were sold out. Mints were shut down. Premiums went from $2 to $10 overnight. And the people who waited paid triple what they would have paid a month earlier, if they could buy at all. The signals were there before that happened. Premiums were creeping up. Delivery times were extending. Inventory was thinning. But most people were not watching. They were watching the price. And the price lied until it did not. So what should someone watch instead? First, dealer premiums. If premiums are rising while the official price is flat or falling, that is pressure building. Second, delivery times. If orders that used to ship in days now take weeks, that is supply strain. Third, inventory availability. If out-of-stock messages are multiplying across multiple dealers, that is demand overwhelming the system. Fourth, bid-ask spreads. This is the difference between what dealers will pay to buy silver and what they charge to sell it. When the spread widens, it means liquidity is drying up. It means dealers are unsure, nervous, protective. Fifth, mainstream media silence. This might sound backward, but silence is a signal. When silver is boring to the media, when nobody is talking about it, when it is not trending, that is when the smart money moves. Because by the time the media is screaming about silver, the opportunity is already gone, the herd has already arrived. Sixth, central bank behavior. When central banks start buying gold and silver, when governments start hoarding physical metals, that is not random. They know something. They are preparing for something, and they are doing it quietly. Seventh, currency weakness. When the dollar weakens against other currencies, when inflation reports keep coming in higher than expected, when governments keep spending beyond their means, these are not isolated events. These are systemic warnings. And silver, historically, responds to these warnings. Not immediately, but eventually. So the question is not whether these signals matter. The question is, will someone act on them before everyone else notices? Because the crowd moves last, and the crowd pays the highest price. The prepared move first, and the prepared get the advantage. Right now, the signals are visible. Right now, the window is still open, but it is narrowing. And the business owners who can read what is actually happening beneath the surface, beneath the headlines, beneath the noise, they are not waiting. They are positioning, quietly, strategically, while others are still debating. There was a trader in the 1980s. His name was Paul Tudor Jones, and he saw the 1987 crash coming before it happened. He did not panic. He did not guess. He simply prepared. He built a position based on what the signals were telling him. And when the market collapsed, when everyone else was losing fortunes, he made millions, not because he was lucky, because he was disciplined. Discipline is the difference between surviving a crisis and being destroyed by it. And right now, with silver entering a critical decision window, discipline is everything, because the next few weeks will test everyone who owns this metal. Prices will move, news will flood in, opinions will fly in every direction, and the people who react emotionally will lose. The people who follow a system will win. So what does disciplined response actually look like? It starts with one simple truth. Urgency is not the same as panic. Urgency says, the situation requires action, so I will act strategically. Panic says, the situation is out of control, so I will do anything. Urgency builds a plan. Panic destroys wealth. Right now, there is urgency. The signals are clear. The window is narrowing. The opportunity to position calmly is fading. But that does not mean someone should empty their bank account and buy silver tomorrow. That would be panic. Disciplined response means asking the right questions first. Question 1, is the foundation solid? Before adding any silver position or increasing an existing one, the 4 pillars must be checked. Is there a cash buffer? Is debt under control? Are skills being developed? Is there a balanced allocation plan? If any of these pillars are weak, fix them first, because silver cannot save someone whose financial foundation is broken. It will only create a false sense of security that collapses under pressure. Question 2, what is the position size? This is where most people fail. They either go too small, and the position does not matter, or they go too large, and they cannot handle the volatility. The correct size is the amount that can be held through a 30% drop without selling. If someone buys silver and the price drops 30% the next month, will they panic? Will they sell at a loss? Will they lose sleep? If yes, the position is too large. The goal is not to maximize silver holdings. The goal is to build a position that can be held calmly through chaos, because chaos is coming. Silver does not move in a straight line. It spikes. It crashes. It sits dead for months. Then it explodes again. This is normal. And the people who cannot handle this get shaken out at the worst times. They buy high because they feel excited. They sell low because they feel scared. This is how wealth transfers from the emotional to the disciplined. Question 3. What are the downside scenarios? Most people only think about what happens if they are right. If silver goes to $50, I will make this much. If silver goes to $100, I will make that much. But disciplined investors think about what happens if they are wrong. What if silver drops to $20? What if it sits flat for 2 years? What if the premiums collapse? A disciplined plan survives all of these scenarios because the plan was never betting on one outcome. It was building resilience across multiple outcomes. If silver goes up, great. If silver goes sideways, fine. The other pillars are still working. If silver drops, no problem. The position size was correct, so there is no forced selling. This is how financial resilience actually works. It does not depend on being right about one thing. It depends on being protected no matter what happens. Question 4. What is the exit strategy? Most people never think about this. They buy silver, and then what? Do they hold forever? Do they sell at a certain price? Do they trade it for something else? Without an exit strategy, there is no plan. And without a plan, emotions take over. Disciplined holders define their exit criteria in advance. Maybe it is, I sell when the debt crisis reaches a certain point. Maybe it is, I hold until silver becomes overvalued relative to other assets. Maybe it is, I never sell. I pass it to the next generation. It does not matter which answer someone chooses. What matters is that the answer exists before the pressure arrives. Because once emotions are involved, once the price is moving violently, decision-making becomes impossible. The plan must be written now. Question 5. How will volatility be handled? Silver will test every holder. It will drop when it should rise. It will rise when it should drop. It will do nothing when action is expected. This is not a bug. This is a feature. Volatility is how the market removes weak hands. It shakes the tree until only the committed remain. So the disciplined response is simple. Stop checking the price every day. Stop reacting to every news headline. Stop letting emotions dictate decisions. Instead, check the structure. Is the cash buffer still intact? Is debt still under control? Are skills still being developed? Is the allocation still balanced? If yes, then nothing needs to change. The price can do whatever it wants. Because the strategy was never about the price. It was about resilience. Now, here's the final truth. The next few weeks will separate 2 types of people. The first type will hear this message, feel a sense of urgency, and then do nothing. They will think about it. They will talk about it. They will wait for more confirmation. And by the time they are ready to move, the window will have closed. The second type will hear this message and take one action today. Not everything, just one action. Maybe they calculate their cash buffer. Maybe they list their high-interest debts. Maybe they research one new skill. Maybe they buy a small position in silver, sized correctly. It does not matter which action. What matters is movement, because preparation is not a destination. Preparation is a rhythm, and the rhythm starts with a single step. So here's the choice. Someone can wait and hope the system stays stable, or someone can prepare and know they will be fine either way. The window is open now, not forever. Now, the signals are visible now, not later. Now, the opportunity to position calmly exists now, not after the panic, now. And the business owners who understand this are not waiting for permission. They are not waiting for certainty. They are not waiting for the perfect moment. They are building the 4 pillars. They are sizing their positions correctly. They are preparing for volatility. They are defining their exit criteria. And they are doing it while the room is still quiet. Because when the room gets loud, when everyone is moving at once, when the headlines are screaming, that is when preparation becomes expensive. That is when availability becomes scarce. That is when discipline becomes the only edge left. So the question is not whether someone should prepare. The question is, will they prepare now, or will they wish they had? Because the window is closing, and history does not wait for anyone. The disciplined move now. The unprepared move too late. And the difference between these two is not luck. It is choice. Choose now. The window is open. The signals are clear. The choice is yours. If this analysis provided value, subscribe to Currency Forensics, because the next phase is already beginning and we will be watching.